Hello, everyone. Today on the Final Bar, I have a great guest for you. Larry Tentarelli of Blue Chip Daily. We'll hear what he is thinking about this market, certainly in a distribution phase, feeling more and more like that's the case as the day goes on. NASDAQ finishing down 2%. Are there still good ideas out there? Ladies and gentlemen, this is the Final Bar. Hello, everyone. It's Thursday, March 9th. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of technical analysis. Now, the technical toolkit is designed to help you understand the markets by focusing on price dynamics, focusing on the message of price and breadth and sentiment, on trend and momentum, how we can define the direction of the market and the strength of the market, either to the upside or the downside. Days like today certainly make me very thankful that I have a toolkit focused on price action so I can really think about how today's move fits into the bigger picture. But it's also a great reminder on recognizing the multiple timeframes at work. I always tell people make short-term decisions using short-term data, make long-term decisions using long-term data. Let's see if we can sort of tease out the relationships between what we saw today and the overall sort of bigger picture that we've been talking about here for quite some time. Let's get right into our market recap. As I mentioned in the introduction, plenty of weakness right through the course of the day. And while the open was actually a little bit stronger, the S&P actually pushed above 4,000. It feels like many lifetimes ago back at the open of today's session, but the S&P actually opened a little bit strong, right? And actually moved to the upside. But very soon around the lunchtime hour, rotated back into negative territory, pushing lower, almost getting down to 3,900 before the end of the day. Closing the S&P around 3918. That's down about 1.8%. from Wednesday's close from yesterday. The NASDAQ composite pushed down over 2% to 11,340, just below that. Mid caps, small caps, all down as well. And the VIX pushing well above 20. It actually was interesting, earlier in the day, the VIX was pushing above 20 in the afternoon. I'm thinking, wow, that's quite a significant level to be broken. By the end of the day, we almost we actually briefly pushed above 23, settled in just above 22, but this is certainly way above where we were even just yesterday. Above below 20 is one of those basic gauges I've always paid attention to with the VIX as a loose definition of lower volatility or higher volatility environment. Very quickly, we're pushing more into the environment that I would probably loosely describe as high volatility. Now, interest rates moving lower through the course of the day. Today was sort of bonds higher, stocks weaker in a big way type of move. So you have interest rates moving down. The 10-year yield currently around 393, and the shorter yield still around 485 on the short end of the curve. Bond prices, of course, going higher in that environment, and the dollar index about 0.25% lower from Wednesday's close. Very few things that are green. And on a day like this, when it feels like everything's down, I find it's really helpful to look at what is not, right? What actually is not performing in line with the overall market trend. Where are the outliers, right? Sort of those barbells of outperformers on a down day or underperformers on a big up day. Gold and silver actually fit that criteria. The GLD actually up 1%. So we talked about how gold really hasn't been a safe haven for quite some time. Recently, gold stocks, the gold, spot gold or the GLD, the gold ETF, all rotating lower here. Today, sort of a bit getting back to its roots as more of a safe haven of sorts, with gold moving higher by about 1% as the major average is moving down by about double that. The energy part of the commodity space, for the most part, in the red, with oil, natural gas, and others moving to the downside. If you like the color red, you're going to really like the cryptocurrency page. Unfortunately, all 10 of the top coins that we track really pushing to the downside. Now, Bitcoin and Ethereum and others trade 24 hours. So when you're looking at the S&P sort of two-day chart, you have to remember you're looking at, the trading session for yesterday and today. When we looked at cryptocurrencies, we're actually looking at the last 48 hours of trading. So we're going back quite a bit. you can see this acceleration to the downside where it looks like Bitcoin and Ethereum are falling off a cliff. That's where the U.S. market really, equity market started to really roll over. And again, cryptocurrencies in general performing very much like a risk asset. There was this time earlier in the life cycle of cryptocurrencies where I remember being told that they were a differentiated source of alpha, that they're not highly correlated to stocks, or that was the expectation because of the very unique structure. If you look, I think they certainly seem to be more of a petri dish for speculative pressures, right? When investors are optimistic or pessimistic, I feel that's usually reflected in equity prices and is sort of magnified or leveraged with the chart of cryptocurrency. So while the major equity average is down about 2%, Bitcoin, Ether down over 6.5% as we're going live on the show here. Bitcoin getting closer and closer to 20,000, which is a big horizontal line I have on my charts, which is a potential area of a concern. We'll get to the chart of Bitcoin here in a few moments, but I do want to look at the chart of the S&P 500. So here's the bad news for bulls and fans of bullish conclusions from charts. I'm not feeling it today, and I'll tell you why. As we've had with some of our conversations, like with Aaron Swenlin yesterday, turning pretty heavily bullish based on the action that we saw yesterday and deterioration in breadth conditions, particularly in the short term. I talked to some of my guests, like Mike Siccardi and others, about what levels you need to hold, right? What levels, what line in the sand would you see that if we break that level, we hit that signal, we break that pattern, that it would tell you that the conditions are not as bullish as they might have seemed, and now we're starting to rotate. I've been inclined to think of this market as a consistent pattern of higher highs and higher lows off of the October low. And we can see, of course, we've been putting in a higher low there in late February. But as we rally back into this blue shaded area, this is a congestion area we talked about from a number of different techniques, sort of focusing on a 4,000 to 4,100. Above that, that range, conditions are pretty good, which is why in early mid-February, the market looked great. I would argue from a technical perspective, as a trend follower, felt a lot to like as we were sort of making new swing highs. We're pushing toward the August 22 high around 4,300. Seems sort of long and strong, everything good. We then had a pullback, which is totally fair. And the question was, can we hold some of these trend lines? Can we hold moving averages which track the overall configuration of this trend? One by one, I've seen those levels of support get broken. First, it was the trend line off of the intraday lows, which we broke actually a couple weeks ago, right? We broke below that level. We traded back above it briefly, but then rotating back to the downside. We then, just today, after testing it yesterday, today's close pushes us below a trend line using the closing prices. And we also today have now closed below the 200-day moving average. We haven't closed below the 200 days since the middle of January. So we're going back about 2 months on the last time that we were closing below this key measure of long-term market trend. So it's hard for me to be super constructive with the S&P below 3940, or below the 200-day moving average. If we can get back above there, if this was just a big capitulation and we recover tomorrow, this chart could look very different very quickly, as it has in the last week. However, getting below the 200-day is not a check in the positive column. Also, the RSI getting just below 40 could be the beginning of a further downside momentum push. That's something to watch, I think, as well, to see if we get a recovery sort of back above those levels. Just to finish off here very quickly before the break, in terms of sector leadership, really defensive sectors at the top of the list, with utilities and consumer staples, the top two sectors, followed by healthcare. Now, all of those down about 0.8 to 1%. So all 11 S&P sectors in the red. On the downside, financials really pushing the way lower, followed by materials, and then consumer discretionary. What's interesting when you think about financials, I was actually talking with Grayson Rose here on the StockCharts management team. We were reviewing some of the charts together, and the first time I saw him, he just said, all right, look at insurance, look at broker dealers. We brought up these charts and sort of looked at them. Look how quickly the insurance ETF has changed from what I would argue has been a fairly constructive chart, December, January, February, making successively higher highs, making higher lows. After breaking above the high from 2002 or early 2022, this felt like a very constructive chart, making a new 52-week high, getting to 95. Just about a week, really 3 days, to be honest with you, going back to Tuesday's session. Look how the complexion of this chart has changed very quickly. Now, the IAK, the insurance ETF, still holding above its 200-day moving average, but certainly rotating to the downside. Broker dealers, IAI is another, it's an iShares ETF tracking that part of the financial sector. Again, holding its low from December, holding the 200-day, but down quite a bit just in a week. And so you're seeing this deterioration, not just in price moving lower, but in the momentum. In this case, the broker-dealer ETF oversold for the first time since September of last year. Just to finish off here very quickly, and then we'll get to the break, is looking at Bitcoin. I just wanted to mention this. I had a really good conversation with Adrian Zadunchik, who's a cryptocurrency expert and a fantastic guest on the show last week or the week before when I had him on. We were talking about sort of the long-term structures in Bitcoin. I'm a huge fan of the long-term thesis for cryptocurrencies, particularly the blockchain technology. I think it's undeniable. Those are transformative technologies, but there's a difference between those long-term investment theses and what's actually happening in the short term, right? We live and die in some ways by the flickering ticks, the movements in the short term. And what's happened here in the last week is you've seen Bitcoin and Ethereum rotate lower. Today, Bitcoin is actually pushing below a key support level. If you take the high from last November, you can see we tested that in January before breaking out. We tested that from above last month in mid-February, then made a new swing high, testing the highs from August. We actually stalled out there on a bearish divergence and now back below that level of support. We're getting near to that 200-day moving average. I just posted a video a couple hours ago on my YouTube channel digging into this chart in a little more detail, highlighting the 3 bearish signals I would argue we've gotten here in the last couple of weeks. I'd encourage you to check that out. See what you think and where you think Bitcoin is at relative to where it needs to be or where it may be next. Finally, again, I think as we're thinking about charts and opportunities, as always, I'm thinking about how the complexion has changed. A chart like Starbucks is another one, kind of like the financial charts. Bearish divergence December into January, lower momentum as you make higher prices. That's been the peak now for 2023 as we're now making lower highs, lower lows, breaking below the 50-day moving average, the momentum right below 40. So very quickly, it's interesting to see how quickly some of these charts can change from, I would argue, fairly straightforward bullish configurations to very bearish. And I would argue one of the great benefits of the technical toolkit is helping you recognize when the conditions change. We might be in one of those environments right about now. Let's take a quick commercial break. We'll be back with today's guest, Larry Tentarelli. We'll see you in a minute. Hey, everyone. Welcome back to The Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close. All of our previous interviews and episodes can be found at StockChartsTV.com. A couple announcements before we get to our guest today, Larry Tentarelli. First off, we welcome your feedback on the show, on our guests, on your host, but especially we appreciate your questions. We're going to do a mailbag segment on tomorrow's show. I will not be answering those questions, though. I'll tell you in a moment who is going to be doing it and why. But I'll be back on Monday. I'll be answering your questions there as well. Shoot us an email with any questions that you run into as you are trying to analyze the markets with your own toolkit. TheFinalBar@StockCharts.com is our email address. You can find us on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our YouTube channel. I hope to answer your question live on the air. Just to let you know about the upcoming schedule for the show, tomorrow I will actually be off. I'm on the board of directors of a music school called the Walden School, based down in San Francisco. I'll be going there for a board meeting. My friend and fellow Stock Charts contributor, Erin Swellen of Decision Point, she was our guest on the show yesterday. She will be with you the whole show tomorrow, guest hosting, answering your questions as well. So if you've ever wanted to ask Erin some questions about the Decision Point methodology or how she is approaching the market using their tools of momentum and breadth, send them in to us today. We'll make sure we get them in front of you. Next week, a couple guests to highlight for you. On Wednesday, the 15th, we have Ryan Dietrich. He's the Chief Market Strategist at the Carson Group. And then next Thursday, March 16th, we'll have Ms. Schneider, the Director of Trading Education of Market Gauge, coming back on our show. I want to welcome on today's guest, who's one of my favorites and a regular guest on Stock Charts TV and on my show, Larry Tentarelli. Larry's the editor of the Blue Chip Daily Trend Report, coming to us from New England. Larry, great to see you. Welcome back to the show.
David, great to see you too. Thank you for having me back.
It's a pleasure. I will tell you, I'm going to have to start thinking about shorting the market when I know you're coming on, because this is starting to be a pattern of you coming on and seeing some short-term weakness. I don't think it's your fault, but as a technician, I'm noticing this pattern that we'll have to talk about at some point.
I hope it's not my fault.
I hope so too. Now let's get to your first chart. We're looking at AMD. The semiconductor space has been, in a lot of ways, one of the stronger places year to date. What do you see that you like or don't like on the chart of AMD here today?
So a lot of things that I like on the AMD chart. So it started to break out again today. So AMD has been higher. It looks like 7 or 8 of the past days. It's had a higher high each of the past 7 or 8 days. It had a big breakout after earnings in the beginning of February, a high volume breakout. Then it pulled back just below the 200-day, but it held 75. It held the rising 50-day. And then just this week, it reclaimed the 20-day moving average. It's got a rising 50-day. It's right now, it's over all four moving averages. And as of today, it looks like it tested 87.81. So it tested a bit of a range breakout before the market pulled everything down today. But if you look at semis overall, they're set up very well. And I think AMD is just below a breakout level here.
It's very, very interesting. We're sort of getting back up toward those February highs. And it's amazing how, when you think about the strength in versus weakness in the market, charts like semiconductors certainly feel like a bit of an outlier in that they're continuing to strengthen here. I'd love to just, take a step back if we could. I think of you as one of my favorite stock pickers to talk to, always thinking about the pure, just looking at the charts and looking at the opportunities. How do you feel about semiconductors working in this environment as the market overall are a little less stable? Are semiconductors a bit of a safe haven as sort of the backbone of the economy in 2023? How do you think about it? Do you think there's a case to be made there?
I don't think we can say safe haven. Semiconductors are extremely cyclical. No. So they're very tied to the health of the economy. But if you look at the semiconductors chart, SMH, it's been holding up better than triple Q. It's been holding up better than SPY. You can see it's got a rising 50-day, a rising 200-day, just below a potential breakout level. So if you look at where SMH is on the chart versus, say, triple Q, which is down in the lower third of the chart, the semis are leading. They're leading their sector. I don't know. I don't know why. I couldn't tell you why. The semis are mostly profitable. They do tend to trade at lower valuations for the most part, but they've just been very strong.
It's a good example, and AMD probably representative of a number of semiconductor stocks with some fairly constructive structures. Your second chart is PAVE, which is an infrastructure ETF that we have talked about on the show randomly over time. What do you like about this particular idea?
So this is one of my favorite charts overall, and if we take a look, we can see it just broke out this week to a new 52-week high. Before today, it had been trading over 4 moving averages. It's got 3 rising moving averages right now, but it's the industrial sector. This ETF, I believe, is about 70% in the industrial sector. And the industrial sector itself is one of the best overall sector charts on the screen. If you take a look underneath the surface, General Electric, Eaton, Parker Hannifin, Rockwell Automation, they're off the top of my head. There's 10 or 15 industrial large caps that are just below new 52-week highs. That's the same thing that we see with PAVE. It is leading versus the S&P year to date. It's leading versus industrials year to date. And if you take a look going back to the end of February, beginning of March, you can see there's a lot of high volume up bar days that came in. And then today was pretty much a washout day where, and you and I spoke about this beforehand, there was no place to hide. Other than General Electric, there was really no place to hide today. Yeah. But this industrial sector ETF is just in a very nice uptrend. It's in a base on top of a very wide price base with support at about 28.50. And now, obviously, what happens with the overall market if we get a washout like we did today, gravity pulls everything down. But this is one of my favorite charts just below a potential breakout level.
When you're looking at a chart like this, I think on a day like today, a lot of people naturally, just sort of get anxious about how quickly the configuration can change, how quickly the markets can move lower. When you're looking at a chart like this of PAVE, Can you help us relate what we saw today versus more of the longer term picture? What would you see on this chart that would tell you, okay, this beautiful sort of secular, more long-term story is now brought into question versus this is just a big washout day within a bigger uptrend? Like, is there a particular level? Is it the moving averages changing direction? What would tell you that something really bigger is different?
By looking at this chart, $27.50 to $28 is really a key support level that I'd want to see that hold. It's about 10% off the recent high, but it's just under the 50-day. It's over the 100-day, but there's a lot of support. But if it breaks down below, let's call it 27.50, then it would lead me to believe that this is more than just a routine pullback and maybe more of a change in the longer term trend.
Yeah, really, really good point. I love that way of thinking about it, and just trying to help us make sense of a big down day like this, Larry. Your third chart is getting into the energy sector. Now, energy, you and I have talked about energy before when you've come on the show, and some of the patterns have been incredibly resilient. A lot of people questioning that as oil prices have remained lower. MPC is the chart we're looking at here. Talk us through your take here.
MPC is the best longer term chart that I can see in the large cap energy sector. Energy's been a difficult sector year to date. I think XLE is maybe flat for the year, maybe. I think Exxon is, Chevron's down, Occidental, Devon Energy, those have rolled over. Some of the European names, Shell and BP, have been strong. But MPC Marathon, it's number one, it's in a very long-term uptrend. As of today's close, it's still trading over 4 rising moving averages. It's held the 100-day, it looks like, since September. It's one of the top performers year to date. And I believe, and I'd have to double check my numbers, but I believe it's the number one large cap energy sector stock over the past 12 months. And I believe it's in the top 3 year to date. I'd have to check that after today. But I mean, if you just look at the chart, it's a pretty steady uptrend. Now, it's volatile like that sector can be. And this is a volatile market. But to me, just looking at that chart, that 100-day moving average has been trend support. Really going back to September, it had a little bit of a head fake. And if we wanted to go further, the 200-day is held over the past year. But I'm still a believer. Now, I am a believer in the energy story. I still have a position. I've got Exxon right now, which has been a bit of a laggard, but I have a bit of a longer term time frame. So I'm not looking to jump from one stock to the next because it underperforms for a week or two. But I think as long as crude oil holds over 70, then I think the energy sector still, it looks bullish longer term. But you really have to be careful because there's some charts there like Occidental has pretty much rolled over. Yeah. Devon Energy has pretty much rolled over. You can't see it as much on the chart right now, but if you take a look at where Oxy is, it's underneath the 50-day. The 200-day has started to roll over. And just for me, as a trend follower, I like to see uptrends. I'd rather see those moving averages. If you pull up MPC again in your screen,
yeah,
you see it's a totally different chart structure.
Completely different, yeah.
So for whatever reason, and this is the beautiful thing about technical analysis, we don't have to be experts on the energy sector. There's refiners and there's E&P and there's oil field services and all different factors that we don't need to know anything about. But the people that do have continued to go with Marathon while they've continued to sell off charts like Occidental. So if we just follow the money and assume that the market knows what, the variables. So that's why just looking at the MPC chart, it's a very strong chart. As long as it holds that 200-day, it's been over the 200-day longer than your chart.
That's right. That's right. It's so that's a brilliant illustration of just the relationship. Something like the energy sector, I tend to think is pretty homogenous. It's sort of like they're all doing the same thing, but there often is a bit of a differentiation in there. You compare the strength in something like MPC to the weakness and things like Fang, Devon Energy. Some of those previous leadership names really starting to rotate lower. Larry, this is awesome. What a fun conversation. I really appreciate you bringing some ideas and being willing to go sort of anywhere and everywhere as we make sense of a day like this. So be well there in New Hampshire. We'll talk to you again soon, all right?
David, take care. Thank you. Have a great day.
That's Larry Tentarelli. Larry's the editor of the Blue Chip Daily Trend Report. He is super gracious and often shares some really good charts on social media. I'd encourage you to follow him on Twitter and check out some of the charts that he shares. I love that sort of discussion about the relationship between the charts and sort of the fundamental stories. We would often say in my previous life as an institutional investor, the technicals tell you, where to be. The fundamentals tell you what happened. It's often sort of a retrospective, okay, that's why things actually played out the way they do. That's why these companies actually diverged in a meaningful way. But the charts often lead the fundamental stories, right? Or as another way that I would say it, the evidence or the reasoning always looks crystal clear in the rearview mirror. That was a wonderful take there from Larry Tentarelli at the Blue Chip Daily Trend Report. We need to wrap the show, folks, and go to the 3 in 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. In our market recap, I mentioned my conversation with Grayson Rose here at StockCharts. We were looking at some of the financial ETFs in the iShares family. We looked at IAI, which is the broker-dealer ETF, down a little bit more, but ended the day down just under 5%. What's interesting about this is if you take the June, July lows from last year, which was the low for the cycle, you take the peak that we reached just a couple weeks ago, right, in early February, this is making a new swing high yet again, and it sort of felt like it was setting up for a return to new all-time highs, if not further. The deterioration really happened over the last couple of weeks, but today sort of an exclamation point. Today's close actually pushing us below that first Fibonacci level. And usually that to me is sort of the initial big question mark. Breaking the 50-day, breaking a Fibonacci level, those are times when I revisit a thesis and say, all right, is this uptrend still in place? We're holding above the December lows for now. We're still above the 200-day moving average, but both of those levels, I would argue, now in play as we've broken below 96. Chart number 2 is looking at market breadth. In our recap, we didn't get too much into the breadth conditions, but I have shared this chart recently because I think it's a really interesting way of comparing the short term to the long term. My conversation with Mike Zaccardi, I think that was on Tuesday, we were talking about, sort of the short-term breadth characteristics versus the long-term. My conversation yesterday with Aaron Swenlin, we dug into some of the short-term breadth conditions, which had changed so quickly just from Monday of this week to Wednesday of this week. Now look at what's happened on this chart. On the bottom, we have the percent of stocks above their 50-day moving average. It's down to 27%. Percent above their 200-day. As of today's close, just narrowly getting below the 50% level. And I think that's really important. We are unable to hold 50% on that level. The S&P closes below its 200-day. Now over half of S&P stocks are below their 200-day as well. That is not a good look if you're bullish. And it tells me to expect further downside over upside if those levels of support on a breadth indicator are not able to be held. Finally, just a little visualization idea for you. I was actually looking at some charts to put in our sample chart gallery here at StockCharts.com. By the way, if you don't know what I'm talking about, click on Charts and Tools. On the right side, you will see a little thing that says Sample Chart Gallery. There's some really cool chart styles that myself, John Murphy, Alex Elder, many others have contributed. These are some of the standard charts that we use, some of the power users and our contributors have used every day to analyze the markets. We allow you to take those chart styles, copy them to your own login, and start to analyze them a little further. I'd encourage you to go through that library. We are actually going through and coming up with some new charts that we could incorporate there. This is one I'm working on. It's called a moving average ribbon. Basically, it looks at a series of moving averages. You stack them on top of each other. And instead of looking at one particular line like I was doing with Larry Tentarelli, you look at the entire shape of the moving averages. Look at how the moving averages rotated lower in early 2022, rotated higher in late 2022, now sort of a spaghetti all over themselves. Tells you there's a period of uncertainty. Folks, that's a wrap for the show. I want to thank Larry Tentarelli of Blue Chip Daily Trend Report joining us from New Hampshire. Appreciate all of our previous interviewees. All can be found at StockChartsTV.com. For Stock Charts in Redmond, Washington, I'm Dave Keller. Have a great night. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.